Imagine walking into a bustling office, the air thick with the scent of freshly brewed coffee and the soft hum of keyboards clicking away. You glance around, seeing accountants hunched over their desks, meticulously crafting financial statements, budgets, and forecasts. But what you might not realize is that behind every number, every line on that balance sheet, lies a web of assumption, those unspoken truths that guide the entire accounting process. Let's dive into the fascinating world of accounting assumption, a topic that might seem dry at first glance but is absolutely critical for any business's success. So, what exactly are these assumptions? Simply put, they are expectations and beliefs that accountants hold as accurate without needing concrete proof. Think of them as the invisible threads that weave together the fabric of financial reporting. They help us make sense of past data to predict future outcomes, and they are essential when preparing financial statements. Now, you might wonder why assumptions are so important. Well, they provide a framework for accountants to operate within, shaping their decisions and calculations. These assumptions ensure that financial reports are reliable and consistent, which is vital for everyone involved, from management making strategic decisions to investors assessing a company's economic health. Without these guiding principles, financial statements would be a chaotic mess, leaving everyone scratching their heads in confusion. Let's break down some of the key accounting assumptions that play a significant role in this process. First up is the going concern assumption. This one is pretty straightforward. It assumes that a business will continue to operate indefinitely unless there's evidence suggesting otherwise. This assumption is crucial when accountants prepare financial statements. It allows them to make long-term plans and consider how much capital a company will need to sustain its operations. Next, we have the accrual basis assumption. This is where things get interesting. Under this assumption, revenue and expenses are recognized when they are earned or incurred, not necessarily when cash changes hands. Imagine a company that sells a product on credit. Under accrual accounting, the revenue from that sale is recognized immediately, even if the cash hasn't been received yet. This gives a more accurate picture of a company's financial performance over time. Then there's the monetary unit assumption, which requires that all transactions be recorded in a single unit of measure, typically currency. This ensures that everything is expressed in monetary terms, making it easier to compare and analyze financial data. What about the consistency principle? This principle states that once a company adopts an accounting method, it should stick with it from one period to the next. This consistency allows investors to compare financial results across different years, providing a clearer view of performance trends. And let's not forget about the full disclosure principle. This one is all about transparency. It mandates that all relevant information needed to understand a company's financial position must be disclosed. If a company leaves out critical information, it risks misleading investors and stakeholders, which can have serious repercussions. But here's the kicker: with all these assumptions in place, it's crucial to understand what they do not mean. First, accounting assumptions are not guesses or wild estimates. They are grounded in careful research and analysis. When accountants make assumptions, they rely on facts and qualitative data to inform their decisions. This is a far cry from simply throwing darts at a board and hoping for the best. Moreover, assumptions do not create unrealistic expectations for a company's future performance. They are meant to provide a realistic framework for analysis based on past experiences and data. A well-crafted assumption should reflect achievable outcomes, not lofty, unattainable goals. Another misconception is that accounting assumptions ignore reality or fabricate facts to suit desired outcomes. In truth, accounting is built on objective data, focusing on measurable and verifiable information. This objectivity is what lends credibility to financial statements. It's also essential to recognize that assumptions do not guarantee perfect accuracy or predictability. Even with solid research, uncertainty is always lurking in the background. Assumptions are based on the best available information at the time, but they can change as new data emerges. Lastly, assumptions do not imply that past trends will continue without considering potential changes. The business landscape is dynamic, and companies must continuously monitor their environment and adjust their assumptions accordingly. So, where did this term assumption in accounting even come from? It dates back to the mid-19th century. An English accountant named William Fleming introduced the concept in 1853, arguing that basic assumptions were necessary to simplify economic analyses. This idea gained traction over the years, with influential economists like Carl Menger and John Maynard Keynes contributing to its evolution. By the 1950s, accountants worldwide recognized the importance of certain assumptions, such as those related to depreciation and cost behavior in structuring financial reporting. As we explore how these assumptions relate to accounting, we see they form the backbone of generally accepted accounting principles, or GAAP. The going concern assumption, accrual basis assumption. and others ensure that financial statements are prepared consistently and transparently, allowing users to make informed decisions. Let's look at some real-world examples of how these assumptions play out in practice. For instance, consider a company preparing its financial statements. The accountants will operate under the going concern assumption, believing that the business will continue to operate for the foreseeable future. This belief shapes their long-term planning and investment decisions. In another scenario, imagine a company that purchases equipment. Under the accrual basis of accounting, that expense will be recorded at the time of purchase, even if payment hasn't been made yet. This approach provides a clearer picture of the company's financial health throughout the year. The matching principle is another critical assumption, ensuring that revenues and expenses are matched to accurately measure a company's profitability during a specific period. Take inventory costing, for example. Companies must match all inventory-related expenses with their related revenues to accurately report the cost of goods sold. Now, let's explore the benefits of these accounting assumptions. For companies, they provide a reliable and accurate picture of financial health, reducing the risk of errors and omissions. This clarity allows businesses to make informed decisions about investments and strategic initiatives. For management, these assumptions offer valuable insights into the company's financial state, enabling efficient resource allocation and better budgeting. Investors also benefit significantly. Accounting assumptions provide a clear view of a company's financial performance, making it easier to assess potential returns on investment. Accurate assumptions help investors understand how changes in market conditions might impact their investments, allowing for better long-term planning. However, it's essential to recognize the drawbacks of relying on accounting assumptions. Financial statements may become unreliable if they are based on flawed assumptions. Overinflated or undervalued assets can mislead stakeholders, leading to poor decision making. Additionally, the lack of transparency surrounding assumptions can create confusion, making it difficult for investors to understand the true value of a business's assets and liabilities. In conclusion, accounting assumptions are the unsung heroes of financial reporting. They provide the necessary framework for preparing accurate and reliable financial statements while allowing businesses to navigate the complexities of the financial landscape. Understanding these assumptions is crucial for accountants, management, and investors alike. As we move forward in an ever-changing business environment, staying current on accounting standards and principles will ensure that these assumptions remain relevant and effective. So, the next time you glance at a financial statement, remember that behind those numbers lies a world of assumptions that shape the story of a company's financial health. And who knows, maybe you'll find yourself appreciating the art of accounting a little more, recognizing it as not just a set of rules, but a critical component of the business narrative.